Good afternoon, everybody. This is Dave Bear with Pentegra. Hope you're having a great day. We're going to get started in just a few minutes. We still see a lot of folks signing in. The numbers, it's like watching the meter on the gas pump when I'm putting fuel in my car. It just keeps going up and up and up. So we'll just give it another couple of minutes, and then we'll get started with some cash balance basic plan design. Everybody right now is in listen-only mode. You can submit questions in writing. We'll try to save time at the end of the broadcast to address some questions. If we don't get to all of them at the end, we'll go ahead and we'll respond to you, to your questions by email. So we'll be sure to get you an answer to your question, even if we don't have the chance to address it on here. We're still about 1 minute till. We've still got people logging in. So we'll go ahead and wait another couple of minutes and see how many more are able to join us. So if you're just joining us, this is Dave Bear with Pentegra. We're going to go ahead and wait another 30 or 45 seconds and let people, excuse me, log in, and then we'll get started. You'll be able to submit questions online, and we'll do our best to address those, towards the end of the broadcast. And also, we'll be happy to make this material available to you after the broadcast as well. Still see some folks logging in, but I think we're going to go ahead and get started. So again, good afternoon. This is Dave Bear. I'm National Director of TPA Markets for Pentegra Retirement Services, and I'm glad you could join us today. We're going to talk about cash balance plans, and it's going to be more or less a basic discussion about the plans. We're going to go through a little bit of the basics, not really too deep in the weeds as to the law and how cash balance plans work, just a little bit, and then we're going to go through a case study. I think that a case study is one of the best tools for understanding the benefits of adopting a cash balance plan. So we're going to go through a case study that I think will be typical to most of the folks on the broadcast today. Then we're going to talk just ever so briefly about Secure Act and how it affects cash balance plans. We're going to talk a little bit about a relatively new tax deduction that can be affected by cash balance plans. That's the 199A deduction. Again, we're not going to go too deep in the weeds on that, but we're going to go just enough to wet your whistle, so to speak. And then of course we'll wind up with some questions at the end and maybe a little bit about Pentegra. So the basics. What is a cash balance plan? It's a qualified retirement plan under ERISA. Employers are able to make contributions to the plan. And actually, let me back up just a second. I try to tell people to think in terms of Social Security when you think about a defined benefit retirement plan, where what many of you are probably used to are 401k profit sharing plans. In a profit sharing plan, we are defining the current contribution. With a defined benefit plan or a cash balance plan, we're actually defining a future benefit, and then we're working backwards towards a current contribution, or what's actually in these plans, what is called a contribution credit to the plan. They're tax deductible to the employer. They're not currently taxable to the employee. Earnings are tax deferred in the plan. Um, specific earnings in a cash balance plan do not inure directly to a participant. Again, we're focused on, we're designing the plan to say each participant will receive this much at a future date, and this much that they're going to receive is going to be dependent upon their age when they enter the plan, their age when they retire from the plan, their current wages, some projected future wages. Again, we're defining this future benefit and then working backwards towards a current contribution. Benefits at retirement are taxable upon receipt by the employee, who can defer taxes by rolling them into an IRA. A cash balance plan is it's called a hybrid defined benefit plan. And hybrid in this instance means that each participant, instead of receiving a statement every year that tells them what their future benefit will be from the plan, they're going to receive a statement that says, here is the hypothetical balance of your current account in the plan. So it looks more like a profit sharing account, but the math is decidedly a defined benefit plan math. So the math is we're defining this future benefit and working our way back to the current contribution. Cash balance plans are typically paired with a safe harbor 401k profit sharing plan. We'll talk about that in a few minutes when we go into the case study. The combined non-discrimination testing of the two plans allows most owners and certain key employees to receive higher annual company contributions than they would otherwise receive from a 401k profit sharing plan alone. Many of you are probably used to profit sharing plans, and many of you probably have familiarity with a new comparability or cross-tested profit sharing plan where contributions can be skewed towards the owners or towards certain highly compensated employees, and the owner can control how much their other employees get. The same thing is somewhat true for the cash balance plan. We can have multiple classes of employees, and different employees can receive different levels of benefit in the plan. And here what we're saying is non-owner, non-key employees receive most of their benefits from the 401k plan. That's because in the non-discrimination testing dynamic, we're able to more easily pass our non-discrimination testing by giving non-highly compensated employees more benefit in the profit sharing plan and less benefit in the cash balance plan. Whereas for our owners, our key people, the people that we want to benefit the most, we're able to design the cash balance plan so that it requires us to give them more contribution in the cash balance plan, so that than they would otherwise receive in the profit sharing plan. This chart on this slide, I think, is a great tool to keep in mind. And if any of you are trying to do a screenshot right now, you don't need to. We'll be happy to send this to you. We've got a marketing piece with this chart on it. All you have to do is reach back to us here at Pentegra, or reach out to your local Pentegra representative, and we'll make this chart available. Actually, a broader scope chart than this. But the idea here is that if we were looking at 401k deferrals, let's look at our age 55-year-old 401k deferrals this year are capped at $26,000. If that person, also had profit sharing available to them, our 415 limit in the 401k profit sharing side is $63,500. But on the cash balance side, it's $207,000 that we could potentially have an employer give that 55-year-old. So a whole lot of leverage here with a cash balance plan. And you'll hear me use that phrase more frequently as we keep going, especially when we get into the case study. I'll talk about the leverage that's created by a cash balance plan. Leverage against taxes, leverage as far as the owners or key employees getting more benefit potentially than rank and file employees. That's the kind of leverage that we're going to be discussing in this type of a plan. Contributions in a cash balance plan, are only made by the employer. So employees do not defer into a cash balance plan. Just like a profit sharing plan, contributions are made by the employer, the plan sponsor. Annual earnings are declared by the employer or plan sponsor as an interest crediting rate. So again, the way the plan is designed is that we look at it and we say, this person gets this much in the future, this person gets this much in the future, and so on. And then we assign an interest crediting rate to that, to those contribution credits, and we calculate actuarially the amount of contribution that has to be made every year at the declared earnings rate in order to have the benefit that we've declared in the future. So quite literally, we cash balance plans are less controlled by annual contribution limits, and they're more controlled by future benefit limits per person. So we can take an owner today, for example, and calculate the maximum future benefit that they're going to receive, and then work backwards and determine the amount of funding that's required. And the goal, of course, is to have more funding going to the owners or key employees than to everybody else. And that's generally the goal of most business owners. Benefits are actuarially determined. We mentioned this. We can have different levels of benefit for different folks. And these credits are predetermined each year. Before I go into these bullet points here, let me just say that for our financial advisors who are on the call, if you don't have experience with this yet, you might be thinking to yourself, well, how do we match up an investment trust with this annual rate of return that's declared in the plan that will determine this future benefit that an owner or an employee is going to receive? And we'll talk about that in a little bit. We'll talk about the investment side of these types of plans. All of the assets are held in a single pooled trust that the employer controls or as the trustee with your assistance. And you are trying to target, if you will, the annual interest crediting rate that we're using in the plan. So we are typically using a 5% annual interest crediting rate. There's a safe harbor rate is anywhere from 2% to 5% with these plans, and that's what we're typically using, rather than trying to tie it to the actual investments in the plan trust. and we'll talk a little bit more about that in a few minutes. So who's a good candidate for these types of plans? Businesses with strong profit margins and reliable earnings. Defined benefit plans have required annual funding, unlike profit sharing plans, which can be turned on and off at the flip of a switch, so to speak. So you want to have a client that has good, strong earnings and perhaps profit margins, so that they can afford to continually contribute the contributions that we're calculating for them. Closely held family businesses or corporations with fewer than 50 employees are common, although larger firms do also adopt cash balance plans. We here at Pentegra, we have roughly 300 employees, and we have a cash balance plan. Employers seeking to offer a plan with contribution limits over and above current defined contribution plan limits. That's what these are for. Typically, we see business owners who get into their 50s and realize that they haven't saved enough, so they're trying to save more. And the rest is pretty much self-evident. Employers looking for more retirement plan benefits for specific employees, always a nice thing, and looking for flexibility with retirement plans. And again, I think the best way to appreciate the cash balance plan is to work our way through a case study. And I want to pause here for a second, because it might look a little odd that I'm including a simple IRA in this example. But more often than not, we get a lot of questions about employers that have simple IRA plans, and they're not able to save as much as they would like to, and the question becomes, is this the time to make a change? So I think it's a good place to start with a simple IRA as we work through the iterations of our case study. Also, it's fairly timely. I don't know how many folks on the call are aware of this, but the rules for terminating a simple IRA in favor of starting a 401k plan next year, or a 401k safe harbor plan next year, require that you start taking action right now. Notice is required to be delivered to participants of a simple IRA within a reasonable period of time. That's actually the way the statute reads, prior to the beginning of the election period for next year. And the election period begins 60 days prior to the beginning of the next plan year, not 30 days. So what is a reasonable period of time prior to 11/1 to make notice to employees that a simple IRA plan will be replaced perhaps by a 401k plan next year? Well, it's probably in September, or at the latest, it's probably October. So that's why I also start with this as a beginning point. So in our case study, what I've done, as some of you might guess as we go through, I've created a perfect world. I've created a medical practice with two owners, and one has their spouse working in the practice, and then we have 7 other employees. So fairly typical plan design opportunity where we have medical practices. They're successful. They want to get as much benefit as they possibly can. Maybe they have a simple IRA today because their CPA recommended that they start that way, and now maybe they're ready to move on. And so here's a look at our census. Most of you have heard that terminology before in the retirement plan world. So we have physician A, we have physician B. Down at the very bottom, we have physician A's spouse. We have an office manager, an office employee. We have a physician's assistant, or PA1. We have a couple of staff employees, and we have a nurse practitioner. So, and we have our various dates of birth and ages and wages. And again, in our perfect world here, we've got our 2 owners who are both earning $285,000 a year. Our spouse, our physician's spouse, is earning $75,000 a year, and various other wages. And in this particular dynamic, it doesn't show up here on this. Well, it does show up on this slide. If you'll look over here to this column, physician A has been around the longest. He started the practice. He owns 80%. He has turned over 20% of the practice to his new partner. You can see 1999 versus 2016. You see we have some age disparity here, 1965 versus 1980 in our other owner. We'll talk about that as we start moving through the slides. And so here's a contribution analysis for our simple IRA. And we've got our physicians and owners, and they're kind of grouped here in the middle, and we've got other people up above and below. But going from left to right, we have our deferrals. So we have these 3 who are all maxing out, and various other employees are putting away a little bit. Got one here that's putting away nothing, and they're receiving the match. Our owner and spouse who are over age 50 are using the catch-up provision, and so they're receiving and contributing $25,050, $18,750 respectively. Our other owner, no catch-up provision, $22,050, and various other totals. But if we come down here to the bottom, this is a good place to land on this screen, if you will, we see that our match, our total match is $27,550. $8,200 of it is going to our non-owner group, or non-principals, as we're calling them, non-principals and principals, and $19,350 are going to our principals. That's 70.24% of our total. This little summary, this report summary, is going to become important as we start looking at the next iterations of this, because that's one way of measuring leverage of these various plans. In a tax analysis, and if we have any CPAs on the call, let me apologize right now. I realize this is oversimplified. I realize that we're not taking into account a lot of other information that would be relevant, but that's okay, because this is just for today's purpose, and this is just my little perfect world. But what I want to do is walk you through this. So we have that total employer contribution of $27,550 that we made note of just a minute ago. In a 47% tax bracket, that's a tax save that will create a tax savings, absent of knowing anything else, of just under $13,000, $12,948. That means that that our after-tax savings cost is roughly $14,602. And yet, remember that our principals, our three principals, they receive $19,350 of the $27,550 that cost us $14,602 after the tax savings. Well, that's roughly 133% return on this $14,602. Or it means that we have this is showing as a negative, but we have a net positive of $4,758, even though we had to give our employees contribution. And that's the miracle of the tax savings portion of this. And so, as you can imagine, here we're talking about a simple IRA. When we start moving up the ladder, it's going to get more dramatic. So now the slide has become a lot more complicated. This is a 401k safe harbor profit sharing plan analysis. So in this example, we've got a safe harbor 401k using the 3% non-elective safe harbor. We have a profit sharing contribution using new comparability. And in our new we're treating our owners as equals, even though they're not equal owners. And so that's okay in this example, but just for everyone to make note, we could skew this a little bit. We could treat our 20% owner to a lower profit sharing contribution if we wanted to, because that's what we can do in new comparability. We're using cross testing to define our current contribution. So again, moving from left to right, we've got the $19,550 or $19,500 deferral now. We've got our safe harbor contribution. We've got our profit sharing. We've got our catch up for our owner and spouse. So our owner, our primary owner is now receiving $63,500. His spouse is receiving $35,750 in total. Our other principal is receiving $57,000. Various other amounts. We get down here to the bottom, and again, we're looking at the employer cost, the employer contribution. That's our 3% safe harbor and our profit sharing added together. Our total is $109,136. $84,750 of it is staying with our three principals. We're giving our employees $24,386. That means our principals are receiving 77.66% of the total. So we've gained, even though our contributions have increased, the amount that our staff is receiving has increased, but our leverage has increased slightly as well. And again, if we look at that same tax analysis, not sure why this didn't come out in red like the other one, but no matter. Again, our total employer contribution at $109,138. estimated tax savings of $51,295, net cost after estimated tax savings of $57,843, and now look here, our three principals are sharing in $84,750 of employer contribution. That's 147% return on the net after-tax cost. And again, the negative number at the bottom indicates that we're actually net positive in this example of $26,907. So again, we're gaining leverage as we go. We're providing an analysis in comparing these two plans that can help a business owner make an educated decision, and we're catering to their CPA who will have some input into the validity of these tax savings. So now we add cash balance, and remember several slides ago we showed you that chart at different ages with people getting different amounts of cash balance contribution. So here's our 56-year-old with considered earnings of $285,000. And in this example, what we've calculated is that they can receive $215,000 in cash balance contributions. Now, what we decided to do in this example, and there's a lot of flexibility in how we build these plan designs. In this example, we wanted to devote as much to our principal owner as possible. We wanted to devote a lesser amount to our minority partner. And then what we did was, you see that our physician spouse is getting a fairly nominal amount here in the way of cash balance and also in the way of profit sharing. And there's a reason for that. And that's because we were focused entirely on this number here. We were focused entirely on maximizing physician A, providing a lesser amount to physician B. And then what we wanted to do is we wanted to calculate the minimum gateway contribution for all other employees. And the minimum gateway is the amount here in profit sharing, plus our 3% safe harbor, plus 2.5% in cash balance. So our minimum gateway in this example was 9.5. And then what we really did was we simply started adding a contribution to physician A's spouse until we no longer passed testing. In other words, all of our highly compensated employees, and remember, a spouse of an owner is treated as if they are an owner, whether they own any shares of a business or not. But we started adding contributions to that person until we failed. And quite simply, what we were allowed to do is we were allowed to mirror what everybody else got down here, what all the other rank and file employees received, without having to raise them in order to accommodate her. So if this particular owner said, well, I want my wife to get more, then what would we do? We might have to take a little bit away from the owner. We might have to add more to the other employees. Again, in this example, what I want to get across is that we were completely focused on physician A, and that's why we targeted that amount for physician A. So, in our summary example here, our summary of information, we have a total employer cost of $328,670. And that means, and our owners are getting $296,370, or 90.2% of the employer contribution is remaining with our three principals. And folks, that's the kind of leverage that I really want to demonstrate here. That in this particular example, we've got this huge amount of contribution, most of it staying with the owners. And if we go down here and look at this tax analysis, again, it gets very dramatic as well. So 328,670, estimated tax savings of 154,475, estimated after-tax savings cost of 174,195, and again. So if the employer is giving up 174,195 after their savings, their tax savings, but they're getting 296,370 in their accounts, respective accounts, that's 170+% return on that after-tax savings. Again, in this bubble, if you will, they're presumably $122,000+ ahead of the game by sponsoring a plan like this. Now, and again, I'm making it clear, this is not a real world example. Client CPA will factor this in with all of the other dynamics of their tax position, but it's a good starting place to convey the idea here that these plans can create tremendous, I'll say it again, leverage, where a large amount can be contributed, a large amount of it can stay with the principals, and the after-tax dynamic of it is very exciting. And to up the ante on the tax side of it, I wanted to touch a little bit on Internal Revenue Code 199A. I attended a seminar on this a few years ago, and it came about. It was created in the tax law changes in 1986, but it was amended in 2018. And what it does is it permits the owners of a pass-through entity to take a deduction for 20% of such entities' qualified business income. And I'm going to relay a little bit of information about this, but we're not going to get really any deeper into the weeds about this today because it is highly complicated. But this is a below the line deduction. So these contributions are above the line, if you will. So these are above your a business's net income. Or net taxable income. These are above the line deductions. So deductions to a qualified retirement plan, similar to deductions for other business-related expenses. They are all above the line, and then the line that I'm talking about is net taxable income. So what are we talking about when we're talking about pass-through entities? We're talking about S corporations, we're talking about partnerships, we're talking about LLC or partnerships taxed as an S corporation, we're talking about LLCs taxed as an S corporation, we're talking about sole proprietorships are pass-through entities. So this is who we're talking about in the way of a pass-through entity. So when a pass-through entity has calculated its net taxable income, if that income is above a certain number, then there's a phase out of this 20% 199A deduction. If it's below a certain number, then the 199A deduction may exist in total, of the 20% deduction may exist in total, or it may be a partial deduction. So the point I want to make is that if you've got a client that doesn't currently have a cash balance plan, then adopting one might lower their qualified business income in a 199A calculation below the phase-out level and get them an extra 20% tax deduction over and above the amount that they would perhaps get just for adopting a plan like this and making the employer contributions. So it's a good topic to study up on. There's plenty of information out there on the web. We don't have a white paper on it ourselves, but there's plenty of information on it. It is highly complicated in a calculation, best left to CPAs, but I think it's good to be aware of it in that a pass-through entity that maybe is considering a cash balance plan, it might move them below the phase out and get them an extra 20% tax deduction. So that's, I wanted to just basically mention that about the tax implications. So if we go back to our three scenarios. In the simple IRA, our owners receive $65,850 of the employer contribution, and they give their employees $8,200. In the Safe Harbor 401k profit sharing, the owners receive $156,250, and they give their employees $24,386. And then again, in the cash balance profit sharing Safe Harbor scenario, you can see the gap widening. If this were a line chart, you'd see the lines moving further and further apart. The owners receive $367,870, and the owners give $32,300. A lot of leverage in the dynamic of this type of a plan. A lot of scale. And the examples that we showed here, if I can slide back to these kind of charts, these are just essentially 2 pages of a multi-page report that we create when an advisor has a potential adopter of one of these plans. If an advisor has a client and says, I have a client and they might be interested in this, what you can do is collect this census data that we showed you at the very beginning, and then we can build an example of what their plan looks like today, and then build an example of what it could look like either with a cash balance plan or with simply new comparability or that sort of thing. And these are nicely detailed reports. We have the testing analysis, we have the tax analysis, we have a lot of good information in these reports that can be shared with you and with your clients. And then the same thing we can do, we can take these and put these into a PowerPoint and get on a webcast with you and your client and go through them and help you show them what we've created and answer questions directly for them. I want to touch also on the Secure Act. A lot of things going on with the Secure Act, and one of the provisions in the Secure Act extended the deadline for adopting new plans, but in particular, in this example, adopting new cash balance plans. September through December used to be called the cash balance season, and it's because we get a lot of advisors, excuse me, who reach out to us this time of year and ask about cash balance plans and have us run analysis for them. And we have a lot of employers who adopt cash balance plans in the fall so that they can take advantage of these deductions for the year. And it's quite literally, in theory, you can adopt a plan on December 31st and get the contribution and deduction for the entire year using the entire year's wages as eligible wage. For all of you on the call, we actually don't work on these plans after about December 10th. So get information in early. But Secure extended the deadlines, and I don't know if many of you are familiar with this, but the deadlines were extended such that the adoption date can now be commensurate with a business owner's tax filing deadline. So if let's go back to that pass-through entity. If the pass-through entity is filing in March of next year, you can actually adopt a cash balance plan for this year next March. If they extend their filing deadline, you have until the extended filing deadline. The next bullet, though, is something that I want to make everyone aware of, is that, however, oftentimes we're, if we're working from a client that currently has a simple IRA, they might have until next year to adopt a cash balance plan for this year. But if they want the plan to operate well next year, the plan needs to be a 401k plan next year, and they need to take action on that now. If the client has a current tested 401k, and maybe we can make the cash balance plan work without a safe harbor plan for the first year, but it will eventually be better probably with the safe harbor, we need to be talking about the safe harbor adoption for next year right now, so that we have everything ready. So while it's entirely possible to adopt these plans for next year, remember that the current defined contribution component, which is very important, may not be ideally set up to marry with a cash balance plan. And so we would want to have those conversations sooner rather than later. And that's what that's something I wanted to cover here in this example. The last slide just talks a little bit about Pentegra and who we are and what we do. We've been in business since 1943. We were founded by the Federal Home Loan Bank to operate multiple employer plans for their member banks. We are a national firm with sales teams all over the country, as well as a strong internal sales team, and roughly 300 employees scattered among a half a dozen or so offices around the country when and if we get back into our offices. I see that we ended up with 25 total in attendance. That's great. Welcome all, and thanks for joining us and being with us today. I don't see any questions in the question box, but by all means, if you have questions that you'd like to submit, my email is david.barrer, that's B-A-R-R-E-R, @pentegra.com, or you can simply reply to down here at the bottom, solutions@pentegra.com is fine as well, or you can call our Pentegra Solutions Center at 855-549-6689 and leave a message, and we'll reach back to you if you have specific questions. As I mentioned, you can collect census data, and we can build an analysis for your clients to take a look at. Be happy to walk them through it over the phone or over a webcast. And I guess absent of any questions, we will adjourn, and I will give you all roughly 19 minutes of your afternoon back. Thanks very much, and we very much appreciate your attendance today.